My name's Tanya Fleming. I lead our innovation and finance team in the corporate finance department at the Alberta Securities Commission. And I'm here with my colleague, Meg Hiles. Meg and I are both lawyers, and we have both assisted both private companies and public companies with the legal process of raising capital. We're both relatively new to the Alberta Securities Commission. We're going to talk about a new prospectus exemption that can be used by Alberta-based private or public companies. It's called the Self-Certified Investor Exemption. And just as a bit of background, anytime a company is issuing shares without going through a full prospectus process, they have to rely on an exemption from the requirement to issue a prospectus. And this self-certified investor exemption it's quite easy to use. And if it's used by a company that has shares listed on a Canadian exchange, there's no investment limits applicable to investors. So that is something that is potentially of interest to public companies, listed companies. And two really important messages that I wanted to convey, because of course you'll not remember lots of what we talk about today, but one, we are here to help you. This is a new exemption. We haven't yet had any larger companies use it, so we did want to raise some awareness today in conjunction with the webinar on the life exemption, which has had a lot of use actually already. Because this exemption is one that can be used in conjunction with other financings if they involve an accredited investor. And we know it takes a long time for security law changes to make their way into just the general knowledge. So if you are looking at potentially using this exemption, your advisor isn't familiar with it, please just give us a call. We'll walk you through it and answer any specific questions you have at the time of use. And then the other thing I wanted to leave with you is we really do appreciate your feedback. After this webinar, there'll be a survey that will have some questions on some of the things we're going to talk about today. It's quite short. It'll take about 3 minutes to fill out. And we really do appreciate that feedback. We'll be monitoring questions as we go through the webinar. So, just jump in with questions at any time. Don't wait until the end. But I will just say, Meg and I are the same this way. If we don't know the answer, we're not going to guess at it. And a lot of securities law has these nuances that you have to think a little bit about before you can answer. And so if it's not something that we can just answer right now, we'll follow up with you. So please provide your contact information and we'll get back to you. So as a bit of background, in Alberta, of course, there's been lots of interest and efforts toward diversifying the economy and promoting technology and promoting innovation in our province. At the Securities Commission, we want to support Alberta businesses as they're going through the different stages of growth and raising capital. And when a business is in the stage of raising capital by issuing securities, we want to provide some thoughtful options that will promote an efficient capital market and, of course, protect investors. So in 2019, the ASC did a consultation paper, and based on some of the feedback that was received at that time with how the Securities Commission can help in the capital formation process, the self-certified investor exemption was born. And in my group currently, one of the things we do a lot of is engaging with the market about how we can support the process of raising capital through issuing securities. And we're very interested in your feedback, not just on this exemption, but other exemptions as well.
Awesome. Okay, so in the exempt market, there's lots of different prospectus exemptions that get used, as you might guess. We have lots of people relying on the private issuer exemption, people relying on friends and family, but by far the most popular exemption is the accredited investor exemption. So that's angel investors, kind of more known colloquially. And accredited investor needs to have 200,000 net income for the last couple of years, or 1 million in net financial assets. So that's cash and securities, which not everyone is going to have, obviously. But as regulators, we don't really worry about these guys as much, because from an investor protection standpoint, they're deemed, they have the ability to withstand a financial loss. And as shown on the slides, accredited investors are very important to the exempt market. They provide a lot of capital. It was 11.1 billion in 2021, not last year, 2021. One of the themes that we hear about often, as Tanya was saying, we do lots of outreach, is the desire to democratize investing and allow people who might not meet this accredited investor threshold, these thresholds, to participate in investment opportunities that have traditionally been limited to accredited investors. And as part of those conversations, that's kind of what led to the self-certified as a way to expand the investor pool. So, next slide, please. Thanks. Okay, so this exemption is specifically meant for investors who don't meet the AI thresholds, as I mentioned, but they do have certain financial acumen and they're otherwise deemed qualified to invest for that reason. And so this exemption, it's relatively new. We're still in the testing phase of it. It was first introduced in March of 2021, and then based on some feedback we'd received, we amended it in July 2022. And we'll flag those amendments throughout the presentation. And so the Alberta Self-Certified Investor Prospectus Exemption, it is only relevant to raise capital from investors in Alberta and Saskatchewan. We're the two provinces that are signed on, participated in this pilot. You may know that in the fall, in October, Ontario came out with a similar exemption, but that's for Ontario-based companies and investors. It also will expire in April 2024. And securities law, it's under provincial jurisdictions, and one of the challenges we face is harmonization sometimes, and this is a case where the exemptions are very similar, but there are some very important differences. And so we'll highlight those differences throughout the presentation. And in the survey that Tanya mentioned, one of the things we'll ask about is people's opinion on those differences. And so, yeah, if you have interest in completing that, we'd really appreciate it. And so the future of this exemption is outlined on the slide. It might be we would hope it might be a national initiative. We might extend ours, or it might just kind of fall by the wayside if there's not interest. And so we want to get people informed on this exemption, get feedback on it, see if people are interested in it. And that is part of why we are here today talking to you. This slide just has some general type information that we'll get into more detail on throughout the presentation, but just to kind of introduce you to it. So this exemption, it was set up such that self-certified investors are treated in a generally similar manner to accredited investors, and so they can invest alongside them. So it's this idea of maybe trying to find a way to expand the accredited investor exemption. So if a company is doing a prospectus exempt capital raise, that means the company can use this exemption alongside other exemptions that it might want to use. And so this exemption allows self-certified investors to invest directly into an issuer. So that could be a listed or not a listed issuer, or into special purpose vehicles or SPVs. And it's not on the slide, but resale is allowed under this exemption. So an accredited investor could sell to a self-certified investor, or a self-certified investor could sell to another self-certified investor. And we'll get into a bit more detail on that later in the presentation. And so there is investment limits under this exemption. Application of investment limits is often the case for prospectus exemptions. However, depending on the type of investment, those limits may not apply. So as you see in the slide, if there's certain listed issuers that meet certain requirements, then you might not be subject to financial limits. And the same with if there's certain types of special purpose vehicles involved. But again, we'll get into that in more detail later in the presentation.
Okay, so who can use this exemption? So both individual investors and non-individuals can use the exemption. For individual investors, they must meet certain qualifying criteria, which I'll go into in a minute in another slide. And for non-individual investors, so this is like a corporation or a cooperative, the majority of the shareholders or the majority of the directors must be accredited investors, or they must meet the self-certified investor criteria. For a trust, the individual who set up the trust must meet the qualifying criteria, and the trust must be established for the benefit of specified family members. So the ability to have both individual and non-individual investors is one of the differences between this exemption and the Ontario exemption. So the Ontario exemption it only allows individuals to qualify as self-certified investors. So before we look at the qualifying criteria, there are a few other requirements for individual and non-individual self-certified investors, and one of those is the statutory declaration. So a statutory declaration must have been completed by the investor within the last 36 months. So the first time an investor wants to qualify as a self-certified investor, they need to go to a commissioner of oaths or a notary public, and they must solemnly declare that they have completed the acknowledgement form that's required by this exemption. And then that statutory deck can be used again and again for a 36-month period. The acknowledgement does two main things. The investor certifies that they meet the qualifying criteria, and the investor acknowledges that they understand the risks, specifically the risks with investing in the prospectus exempt market, including the warning that you can lose, you could lose your entire investment. So don't invest more than you can afford to lose. The acknowledgement also makes reference to provision that has to be contained in a subscription or purchase agreement about investment limits, which we'll talk more about in a minute. The issuer can't accept a statutory declaration that they know is false, but they don't need to go out and do their own due diligence on the investor. So if someone is certifying that they have an MBA focused on finance, the issuer doesn't need to go out and try to confirm that or have the investor bring a copy of their degree, something like that. The certifications made by the investor in front of the commissioner of oaths or notary public, and the company that's raising money can rely on that statutory declaration. Again, this is one of the differences with the Ontario exemption. There's no statutory declaration required by the Ontario exemption. So the investor doesn't have to go before a notary or commissioner of oaths and actually make that solemn declaration. So this is the qualifying criteria that's set out in the Alberta exemption. So these are the various designations and degrees that qualify someone as a self-certified investor. And the criteria is set out it's meant to indicate some level of financial understanding. So someone who is a chartered financial analyst, a chartered investment manager, someone who has an MBA that's focused on finance. And then there's one exemption, or there's one qualifying criteria here that actually is a double. So there's a minimum net income amount of $75,000 or $125,000 with a spouse, and that they've passed the Canadian Securities exam, or both the Series 7 exam, which is a US exam, and the new entrance exam. So for those criteria, there's also a net income test associated with it. And again, this is one of the differences from the Ontario exemption. There isn't this additional minimum income required with the Ontario exemption. So another one of the differences. And there's a number of other qualifying criteria in the Ontario exemption. Other certifications that are allowed that would qualify the person.
Okay, I'll just say one thing actually about the statutory declaration that I didn't want to interrupt Tanya, but if you want to use it in both provinces, like both Alberta and Saskatchewan, then you should go to a notary. That's just a little note. Okay, so looking now at capital raising from a self-certified investor. So if a company is distributing to accredited investors, that means they can also distribute to self-certified investors. So if you're doing a raise, then you could pull from both. But it's also worth noting that if the distribution is coming from an issuer, the offering actually needs to be made alongside with an accredited investor. There has to be a concurrent distribution, meaning in this context, a company cannot sell only to self-certified investors. There has to be at least one accredited investor involved. And another point, this exemption, it doesn't have a prescribed offering document, but sometimes people want to give optional disclosure. And if you do give any disclosure and you give some to an accredited investor, you also have to give it to the self-certified investor. And then we realize in the case of resale, there won't be concurrent distribution, won't be possible. And so in that case, it just has to be that you would be giving the same information to an accredited investor that you would give to a self-certified investor. So it's not like self-certified investors are getting worse disclosure. This is another difference from Ontario. In Ontario, there's no requirement around a concurrent distribution to an accredited investor. And then last point on this slide, the purchaser must purchase as principal, so no agent involved in that. Okay, now looking at the investment limits. So as mentioned, and like with many other prospectus exemptions, there are limits to the amount that a purchaser can invest. So those limits are $10,000 into one business or issuer per calendar year, and then $30,000 under the exemption in general for the calendar year. And there must actually be a representation in the purchase or subscription agreement regarding this $30,000 limit, just to make sure people are abiding by that rule. And amounts invested into and I should say one thing is that amounts invested into a listed issuer investment, which Tanya will discuss later, they don't count towards these $10,000, $30,000 caps. So we'll get more into that later. And there are exceptions to these financial limits. So in the case of a listed issuer investment, again, the limits don't apply. There's also a concept of qualifying special purpose vehicles, which is a special type of investing entity built into this exemption. They are also not subject to the investment limits, assuming you meet the requirements. And again, with the differences from Ontario, the investment limits are another difference. In Ontario, there is only a $30,000 annual cap. There's no other limit per investment. The reason why we did this in Alberta was just to try to avoid someone putting all of their $30,000 worth of eggs into a basket that might be risky versus dividing up your investment into multiple businesses.
So while we anticipate this exemption to be of interest to private companies, it can also be used by listed issuers. And then as Meg said, the investment limits don't apply. So a listed issuer investment applies to a company that's issuing securities that has shares listed on a Canadian stock exchange. So a potential purchaser of those securities could buy the company's shares that are already trading on the exchange. In this case, there's no investment limits applicable when you're buying shares of a company that's listed. There's a few criteria. Of course, the issuer can't be in default of the reporting issuer disclosure obligations. And the purchaser does need to receive suitability advice from someone who's registered to provide that advice. So that could be the person's broker. If there's an underwriter involved, they could potentially provide that advice as long as they're complying with their conflict of interest provisions. And so this is where the investor has all of the information about that issuer in the public disclosure. So they can go on to CEDAR, they can find the information, it's already there. So in this case, the investor doesn't need to be subject to investment limits because that information is available, and there's been an involvement of suitability that this investment is in fact suitable for this particular investor. This is another distinction from the Ontario exemption. In the Ontario exemption, there's no concept of a listed issuer investment. So even in terms of investment limits not applying. So even if a company that is using this exemption is listed on a stock exchange, there are still investment limits that apply. Okay, so we've made the point, there's no investment limits if it's a listed issuer, but this really can expand the pool of potential investors in a private placement context. And I think Meg has already mentioned, so prior listed issuer investments aren't included when you calculate the financial investments. So if an investor does a listed issuer investment and then subsequently is investing in a private company, that listed issuer amount isn't going to count toward the limits in this particular exemption.
Okay, and so now turning to these qualifying special purpose vehicles or qualifying SPVs that I mentioned. So this is a vehicle that receives money from both accredited investors and self-certified investors, and then takes that collective money and invests it. The SPV takes that money and invests it. And so a distribution to this type of SPV is also not subject to investment limits. But there are some pretty specific rules that to qualify as this type of SPV. So in general, at least one SPV owner must be an AI. So meaning you can't just have SPVs, or sorry, you can't just have self-certified investors making up the SPV. The investors that invest into the SPV must follow the rules of the exemption, including the limits. So that means that the different companies and individuals that invest into the SPV, they all have to follow the $10,000, $30,000 limits and do the statutory declaration, that sort of thing. And then also 75% or more of the investment money into the SPV has to come from accredited investors. So if you don't meet those requirements, that is still fine, but then you'll just be a regular SPV, and then your entity would be subject to the financial limits of the exemption. Okay, so this qualifying SPV concept, it was one of the things that was part of the July 2022 amendments. We'd received feedback that special purpose vehicles with accredited investors are a popular mechanism in smaller businesses in that space. And we realized it wasn't practical to restrict SPVs to these financial limits in businesses that they were investing into, because the investors into the SPV are already restricted in that way. There's no statutory declaration required from the qualifying SPV itself, but again, that's because the people that make up the SPV have to do those statutory declarations. And this is another difference from Ontario. The Ontario order does not refer to SPVs at all or have this qualifying SPV concept.
Okay, so there are resale provisions applicable with this exemption. So for a reporting issuer, there's a typical 4-month hold, but for a company that's private, the shares are not freely tradable, so they can only be sold under another prospectus exemption. This is, again, one of the changes that we made this summer to this particular exemption. So we added an allowance for resale by existing security holders. So a self-certified investor could sell to an accredited investor, or accredited investor could sell to a self-certified investor. So that's one of the changes. And again, a difference from the Ontario exemption, where there is no contemplation of resale to self-certified investors as part of the Ontario exemption. Now, a company that is doing a prospectus exempt capital raise, they can use this exemption in combination with other prospectus exemptions. So if you're using the accredited investor exemption, you can add on some self-certified investors, all as part of the same capital raise. And for a reporting issuer, a report of exempt distribution is required. It's due on the 10th day after the closing of the distribution. And when filling that out, you have to simply just fill in that you've used the self-certified investor exemption, and then you have to add the relevant paragraph under which the investor qualified. So if someone has a CFA and you're relying on their self-certification by virtue of them being a CFA, then you would indicate the qualifying criteria, which is found in Schedule A, paragraph 1. So you do that in your report of exempt distribution. Now, in Alberta, a private issuer isn't required to file a report of exempt distribution. And again, this is one of the differences from Ontario, where anytime this exemption is used, there has to be a filing. And this is actually an interesting issue for us, because of course we are always thinking about burden, but we're also looking at data collection, and we're in a test phase of this particular exemption. We're responding to feedback from the market that says people want this, they're interested in this. This is part of the democratization of investing. But if we don't know that companies are using this, it's really hard. We don't have any data on that. So If the exemption is used by a reporting issuer or a listed issuer, then there is a report of exempt distribution that's required. And this would be something that would help us in terms of our data collection, as particularly as we're in the test phase of this particular prospectus exemption.
And then just another final point here. So as you likely know, private issuers, they must have 50 or less shareholders, and they are only allowed to sell to certain types of investors, certain permitted investors under the exemption. So that would include accredited investors and also persons that are not the public. But if you're a private issuer, you don't have to worry using this exemption. You won't lose your status as a private issuer just because you sell to a self-certified investor, because self-certified investors, including SPVs, they are not the public for the purposes of the private issuer definition. And so that means they can invest alongside accredited investors into private issuers. But it is worth noting that if you have an SPV, the number of the members of the SPV count towards the 50 shareholder cap for private issuers. It's the same for SPVs composed of accredited investors. So that means that if you are a private issuer and you have 49 shareholders and you want to have an SPV invest in you, but the SPV has like 20 members, then you won't be able to be a private issuer anymore. So, all right. So looking at questions. So it doesn't look like we got any questions for this presentation, but I will raise a question that was raised on the last presentation, which might be of interest for people. So there was a question in January when we did a presentation around the corresponding exemption, which is a definition in our Alberta order. And that definition is that corresponding exemption means it's the Saskatchewan order, the Saskatchewan general order, and any order or ruling of another securities regulatory authority or securities regulator in Canada that provides an exemption from the prospectus requirement that is substantially similar to this blanket order. So the question was around if the Ontario order could qualify as a corresponding exemption. And we are of the view that it is likely the case that this would not qualify because it is not substantially similar due to the various substantive differences, such as the different financial limits and the statutory declaration and all that stuff. So, so no other questions. We'll just move to the last slide. So as Tanya mentioned, we're always seeking feedback on this exemption, and we'd like to speak to people who have used it, who are interested in it, if they have questions or comments, especially if you're a private company, just because we don't get the reports of exempt distribution from you. And as we said before, we'll be sending around a survey just to get a better sense of what people think, people's opinions on the differences between Alberta and Ontario. And as Tanya said, because we are requiring reporting from private issuers, we don't have a ton of statistics, which we would like to have, especially if Ontario has statistics. And so this will be for information gathering purposes and not for any enforcement purposes. And then in general, we have further information on this and other exemptions on the website. And the slides will be available on the website on the link that I know was in Jillian and Tracy's website or presentation. And just if you ever have any other feedback or want any other webinars, please feel free to reach out.
Awesome. Thank you so much, Meg. Thanks everyone for joining us, and we look forward to hearing from you. Thanks.
Yeah, and if you have any questions, feel free to email us.